And again, welcome. My name is Jonathan Harwell-Dye. I'm the Director of Programs for the Arts and Business Council of Greater Nashville. We are an independent 501c3 nonprofit that leverages and unites the unique resources of the arts and business communities to create a thriving, sustainable, creative culture in Nashville. We do this by providing education, resources, and opportunities to the creative community while connecting the business community to the arts to foster workplace creativity and innovation. When you become a member of the Arts and Business Council, you join artists, art lovers, creative organizations, and leading Nashville area companies in cultivating our creative community. Our flagship program is the Volunteer Lawyers and Professionals for the Arts, or VLPA for short, which is a referral service providing pro bono legal assistance to income qualified artists, arts organizations, and creative businesses in Tennessee. The LPA services include quarterly pro bono legal clinics for artists, musicians, and creatives. Our next in person clinic will be held on May 1st at the offices of CMA on Music Row here in Nashville. Registration opens on Monday, April 1st. Please note that you will be required to provide proof of income to qualify for free legal assistance through VLPA. We also host a monthly virtual Black owned small business and nonprofit legal clinic with our partners at the Bradley Law Firm. Tennessee small businesses that are at least 51% Black owned with less than $1 million in annual revenue and 10 or fewer employees are eligible. If you're an independent filmmaker or documentarian living and working in Tennessee, thinking about ways that you might fund your next film or documentary project, we can help. Through IBC's fiscal sponsorship program, we support independent filmmakers and documentarians by providing essential support for projects, including the ability to receive tax-deductible donations and grants, enhancing access to funding opportunities for projects, including opportunities to gain funding from government agencies, foundations, trusts, individuals, philanthropic entities, and other entities that require 501c3 nonprofit status. Eligible media projects must be independent or documentary endeavors, such as shorter feature films, television or docuseries, web series, podcasts, experimental and immersive media, and projects must be produced in Tennessee with at least 51% of production occurring in the state. Now, let's watch a short video from the Tennessee Entertainment Commission about the impact of the film, music, and entertainment industries in the state of Tennessee. As you can see, the entertainment industry in Tennessee is a huge economic driver, and we appreciate Tennessee Entertainment Commission's support of Tennessee's creative industries and for supporting this webinar series. I'm excited to turn over today's program to our panel moderator, Kirk Schroeder. Kirk, thank you so much for being here and for leading today's discussion.
Thank you, Jonathan, and thank you, Tennessee Film Commission, as well as the Arts and Business Council of Greater Nashville for hosting us. We have less than 90 minutes to take you on a ride through film finance. So I'm going to forego all the wonderful introductions and just thank Bianca Goodlow and Donovan Rodriguez. Bianca is coming to us from Los Angeles, and Donovan is coming to us from New York. You have their bios as well as mine, and you can look that up later. Second thing, for housekeeping, we'll be monitoring the meeting group chat if you have questions. I can't tell you that we'll take them all immediately, but we'll try to work them in, and certainly to have time toward the end of the program to take your questions. But if a question kind of fits into what we're talking about, I'm going to make sure that we grab at it. And finally, we could do a seminar just on different components of this. For example, we could do a whole seminar on just the securities aspect of financing film. We could do a whole separate seminar on the debt financing as well as the landscape and things like that. So today we're giving you an overview of the world of film finance. You have a lot of materials to refer to, especially on the debt financing side. we're going to be following generally our discussion outline, but we may skip from that from time to time. So hang on to your seats, and we will try the next 80 minutes or so just to give you a good insight. Jonathan, Bianca, thank you for joining us today. Just kind of open up. I guess the easiest film finance is if someone just writes you a check, right, for the entire film. I had one time had somebody just write a $500,000 check to fund a film. But we'll go ahead and just say that that's the easiest, but we're not going to get into that one today. What
Even
are your
that's not
thoughts? Yes, that's right. What are your thoughts just overall, just overall with respect to the state of film financing today, both on the investment and debt side? We're going to get into both the investment and the debt side, but I just want to open up with just your thoughts on what's the market like? What are you seeing generally in the area of film finance that would be as an opening introduction for our audience? Who wants to go first? Donovan, you want to go first?
Sure. I'm seeing a mix of both equity and debt. Obviously, it depends on the I represent a lot of.
It's lost your.
I think you got
Donovan,
me.
you're on mute accidentally. Go ahead.
Sorry. Yes.
You are.
So from the production side, it depends. Some production companies prefer to give equity because that means the investor is bearing most of the risk as opposed to debt. Although with debt, the investor doesn't see any return unless the film is released and makes some money. But I've seen most investors prefer debt on the one hand because they get a preferred return and they have nothing else to do with the production as long as they're getting a check from time to time. I've seen other investors prefer equity, particularly with respect to sharing in the net profits long term, as well as having some say in the how the production is run. Not actively, but major decisions have to be run by the investors, so they get to vote on certain major decisions that take place. So in my experience, is a mix of equity and debt.
Okay.
And I'd have to dig a little bit deeper and look at the data to see which one comes out on top.
Okay. Bianca, any opening overview of what you're seeing generally in the film finance, just as an opening for our audience before we jump into some of these deeper issues?
Yeah, I mean, it's a busy time. It's been a strange time because, COVID and then the strikes. So there have been bumps along the way, but as a result, I have been more exhausted than ever with the deal flow. So, it's a high class problem, can't complain, but alternative investment classes have been busy, will be busy. And so long as from the investor lender perspective, the approach is sound, and so long as the filmmakers have a reasonable understanding of how to structure these financing models, which is what we're going to go through, I don't expect any change to happen in the sector. If anything, I think it's going to keep growing, and I see a tremendous amount of financing coming now from the Middle East in independently film financed models that are studio or streamer released. So I think it's a good time.
Yeah, I would say that certainly how to finance around streamers and the way the streaming market is changing and they're trying to find their models is interesting. And then, of course, foreign tax credit deals are always a lot of fun. So for our audience, we're going to primarily talk about two major areas. One is the investment securities side, and then we're going to get into debt financing. we're going to start with investor financing, just simply because my guess is that a lot of you will not necessarily have some of the key or important elements to get debt financing right off the bat, especially if you're trying to raise money for the first time and you don't have some sort of element that would appeal to a financier, which we'll talk about a little bit later. So really, you're out there trying to just raise money and just see if somebody will put money in your project. And just as an opening, that when you are raising money, you are essentially offering a security to investors, and they're regulated on two levels: one at the federal level, and second at the state level, which are so-called known blue sky laws. And so each state will have some variation. Now, when you have a security, you will look to have an exemption. So you're looking for exemptions in order to avoid certain regulations or matters. But the key in any type of investment is what type of disclosures you have, what type of documentation, and then what are certain filing requirements. It used to be that certain states follow different model rules on investment. I think we just did a deal with a couple states, and some states say that you must make certain filings before you make an offering. Other states will say that you can make a filing within 30 days after collecting money, just as an example. So when a lawyer or somebody is saying they're blue skying a state for security laws compliance, they are actually just checking on those states in which you are offering. So the key elements, I'm going to then ask Donovan and Bianca to jump in on this. When you're looking at the security side, investment side, the key elements that are going to be very important right off the bat are: where are you making an offering to? Because what will constitute an offering? So if you are offering to folks in 5 states or 10 states, then that could add to the cost of your legal bill, just because you are having to clear or make sure that you're in compliance with those many states, how many people you're offering to, and then exactly what are you filing. Bianca or Donovan, who wants to start on just what are kind of the key things if a client shows up at your office and they're just going to raise money? They just got maybe $1 million or $2 million raise on a small independent film, and they're just going to go out and ask for money. What are some of the key things that you'll want to ask at the outset that someone in our audience will want to be prepared for when they come see you?
Well, before I get into the mechanics, I ask the client, in this case, a filmmaker, I'm presuming, why are you raising the amount of money you're choosing to raise? Because I have this conversation, I beat my head against the wall with clients every day, because it's my job to make sure that they don't spend 10 years trying to raise $15 million, that rather they spend a very efficient 12 months trying to raise $3 million and finding a way to make their movie for that amount of money, or leveraging that through debt. So I tell them, how did you arrive at your budget and this number? And then I explain to them that they should probably throw away that budget because that's a dream budget. And they should revisit with the line producer the script and make very difficult decisions to get to the number beneath which the film cannot be made. And really, that's the budget that we're talking about. Step 2, I ask them to look at the talent, because that's the human resource, that's the asset. The value, commercial value of the talent that we're going to have to be selling. So I asked them to look at their typically 2 leads, and I asked them if they've gone to a sales agent to price these leads, and how do they make their offers based upon what? It's, the agent, it's a no quote world. So the agent can't tell you what the talent's quote is, but the sales agent can tell you, I can sell this actor and this actress in the UK for X, in Germany for Y, in Japan for Z. And you need to take a look at the numbers, make sure that the offers that you're making your talent are justified by the value that they're bringing to the distribution of the film, and then make sure that the cost of that together, exceeds the budget, because you need to obviously have an assumption of profitability. And when we get to that point, then we can start talking about how to structure a private placement memorandum to be compliant with federal and state securities laws.
Donovan, any thoughts when someone comes in?
So my first question is how much? Because if it's $1 million, it's a different consideration from a $20 million film. I've had people come to me asking for a PPM, and when I ask them how much is the budget, they say 1 million, and I tell them right away, you don't need a PPM. One, it's too expensive, and two, it's really not required at that level budget. So how much, when, where, how, who? So who's the offerer? Is it a company, an individual? Where, which states? How many investors are you seeking? What type of investors are you planning to approach? Are they
Do not approach non-accredited investors, no matter
well,
what.
you can approach non-accredited investors, especially at that budget level.
And we're using some terminology that we're going to get into in just a moment. I'm just talking really the first things that you want them, expect them to have as you come in the door.
So how much, what is the project? What's the genre? Is it a feature, a short, a television series? Is it something you plan to distribute overseas? Is it action? So all these things will determine how we package your script and what type of elements are required and how we position it for financing. So, if it's a historical drama, it's a different approach from a sci-fi or a horror film or an action film. So we ask those questions in addition to the amount of money that they're looking to raise. Do you have any funds already available? And then we go into who is attached. Because if you have absolutely no money and it's an esoteric, strange film like Memento that nobody has ever seen before, and they don't know what to do with it, then who's the director, who's the writer? Do they have any credit or track record? Who will be playing the main characters? Those questions.
And both of you, go ahead, Bianca.
I think we should take a minute and talk about the PPM itself.
So let's just quote on this point. It's really important that that you have some idea of how to budget. So when someone comes in and says they're going to raise $15 million for a film project, it might, and they've never done this before, it might be indicating that they're not really sure of what they're doing. Likewise, whether or not a $15 million budget could even make a return on, quote, a movie of the week or some other thing that there's just a disconnect. Second, with respect to a business plan, how is it that you're going to sell your film? Are you going to look for distribution? Are you going to go to film festivals? All those sort of things are critical before, as Bianca said, we get into the mechanics of what are the next steps. We as the finance lawyers can pretty much tell whether you know what you're talking about. And it's not uncommon, at least in my circumstances, where I've gone to people and say, look, rather than pay me right now to do something, you need to go back and do your homework on certain things because you're just wasting your time. Likewise, with security laws, the amount of, depending on how you structure your raise, the amount of money that you will pay in legal fees to raise $2 million could be the same amount of fees as $10 million. It's not on the size of the raise, it's the amount of legal work that's required depending on, as I mentioned before, how many people you're going out to seek investments from, as well as how many states you're going into, and any other components of those
The
requirements.
sophistication level of the subscribers themselves.
Correct.
So
So
you-
just as a quick overview, and then we'll jump back to what Bianca wanted to get into, and Donovan, please jump in. So the basic principle of securities law is the idea that there is disclosure, and that there's transparency in what you're offering. And so uh, for let's just face it, film is a high risk business. The odds of films making their money back or people losing their investment is rather sophisticated. So generally, security laws try to protect people in this type of market. One of the saddest experiences I had were two elderly ladies in their 60s, sisters, who put their life savings up for a project, $600,000 into a film project that was pretty darn well documented. In fact, the lawyers knew exactly what they were doing, and had I looked at the offering early in the game, or had they come to me, I would have told them, do not do this, just because the fundamentals that we talked about in the beginning that you need to come into were not there. And but they could not really challenge the investment. They could not go back and claim any type of fraud or any type of misrepresentation, and I don't know that they ever got their money back. So when you don't properly disclose, you are opening yourself up for certain remedies. Either one, a fraud claim. That is the idea that had I known a piece of information about the investment in the offering, I would not have invested in this. And security laws will basically get into remedies such as the right to rescind or refund the money, or actually allow for a lawsuit. So it's important that when you are going in the process that we're about to talk about in a little more detail, that there is an idea of transparency and disclosure, so that people fully understand the risk involved, and that while there is some puffing that goes on, so to speak, that you're not overstating something in a way that is misleading, that would create potential liability in a very high risk market. So now then, getting into this idea of disclosure, you've already heard the phrase a private placement memorandum. That is a typical format, and we have a checklist, I believe, in our materials about the things that normally go into a private placement memorandum that are typical in the idea of to meet disclosure in a transparent way that will protect you from these sorts of claims. Likewise, the law will get into the notion of the types of investors and what you can or can't do with those investors, which Bianca has already alluded to. So just with that as an introduction, I don't know, Bianca, if you want to pick up, do you want to just start talking about the types of investors that the law recognizes, and how you can approach them, and what sort of things you can or can't do when approaching these investors? And Donovan, just ask you to jump in as well.
Sure. Well, so I wanted to lay out first, a private placement memorandum serves two primary purposes. One is covering your ass, and number two, it's a marketing tool. So when I say covering your ass, there is a very lengthy, robust section of risk disclosures in every, or at least there should be in every private placement memorandum, that looks daunting, but it's intentional, because heaven forbid, should certain investors that subscribe to the PPM and commit capital fail to recoup their investment or, some level of satisfaction for that investment, they're going to be looking with a microscope for any reason to chase the filmmaker who they believe is the cause of this loss. And so that is when the PPM is integral for the filmmaker that's raised the money, because he will invite them to take a second look at the risk section, which says, if you can't afford to lose this money, do not proceed with this investment. There's market volatility. There's absolutely no guarantee of, there being a market. There's no guarantee of distribution. There's no guarantee of there being chemistry on the screen. So proceed at your own caution. So although those things are sufficiently off-putting, it's in my experience, and I've been doing this for a couple of decades, unfortunately, a lot of investors don't really read this going in. They read this the second time around. But at the same time, it's also not just a cover your ass or your armor as a filmmaker, it's your primary marketing tool, because it serves to explain to the investor and invigorate the investor's curiosity and understanding of how the market works. So it's a pretty user-intensive document that explains what it means to be in development, what it means to be in production, what the time horizon for delivery is, what involves post-production, what likely will be the distributor or who will be the distributors of this content. Why do we believe that it's priced appropriately? Why do we believe, based upon comparables, that we've staffed this both above and below the line correctly, et cetera, et cetera. And the goal is then to educate the investor and, excite them. So along with the private placement memorandum, there are certain exhibits that we attach, which is an operating agreement that shows how the company that will be receiving the investment, the company into which the investors are subscribing themselves, how that's operated. So with an operating agreement, there's also an investor questionnaire that you ask the investors to answer. It is quite invasive, but again, it's important to be able to get the investors to cooperate, because you need to ascertain whether they're accredited or non-accredited. When you say a sophisticated investor, non-sophisticated, that's not really a legal term of art. It's really the definition of accredited investor. And I can leave. I don't want to step on all of Donovan's discussion points here. So I'm just going to end after the operating agreement investor questionnaire. There's a subscription agreement through which investors physically subscribe themselves to an ownership or securities in that company. Could be an Inc. or an LLC. More often than not, it's an LLC. Also appended to the PPM is often, and I encourage lawyers to do this, to have a full chain of title in place, because that provides investors the assurances that the asset value, which is the intellectual property, has been assigned to the entity in which you are investing. Investors do not get an opportunity to own the copyright. They own shares in the company that owns the copyright, that has the right to then exhibit and distribute the film and monetize the film in that way, allowing them a percentage of the waterfall or revenue stream. And we can get into what that is later. And that's also discussed in the PPM, how the waterfall works.
Jonathan, you want to jump in on any thoughts?
Yeah, I mean, absolutely. Disclosure of truthful, factual, non-misleading information is essential. Otherwise, you will run afoul of securities laws, both federal and state. And one of the things that I see a lot is in the use of comparables. Filmmakers tend to present just the beautiful picture. They show, they use comps of films that did well, but ignore those films that didn't do so well. And that's really not a good thing or a good idea. You should show similar films that did poorly and explain to the investor why these films did badly and why your film will not do so badly, because you're going to do things a certain way that the other pictures didn't do. And don't use a film that was made for $15,000 that ended up grossing $300 million at the box office for your $2 million project and think that your film is going to perform the same way. So that can be considered misleading information and a violation of the law. I don't know what the budget ranges for the people on this call. But if you have a $2 million movie, it doesn't make sense to spend 10,000 to 15,000 for a lawyer to draft a PPM when you could just create a pitch deck, a business plan, and for much less, and provide the same amount of disclosure that will cover your butt with the SEC.
Yeah, and generally speaking, the fewer the investors you have, and to the extent that they are business colleagues, friends, or family, there are exceptions, usually states, and how you approach the requirements with them. I do want to touch on the concept of misleading. Again, as attorneys, we're helping you craft the private placement memorandum, but we're also critiquing it to make sure that it is not misleading, that generally you're protected. For those that are not paying attention in the chat, you have your first letter of participation for CLE credit, which is code A. One interesting example are one time I had a client, I guess, quietly get rid of me because they had a distribution deal that they were going to promote in the PPM, that the film had a revenue stream coming to it. And when I did the due diligence on the distribution deal, it was easy to come to a conclusion that the best film this distributor had ever done was far less than the total amount of investment for the client was looking to raise. And the client was going to give away worldwide rights to this. So it was inherent in this deal that there was no chance of making the money back had they entered into this distribution deal. And so just pointing out, like, an example that's really misleading, because, and that's something that's going to create liability for you. You are taking on a distribution deal that doesn't even have a snowball's chance in Hades to actually make the money back for the investor is very material. I've had other circumstances where people will put in a PPM that, we have a first right of review or a first right of something, which is really not a distribution deal. It's like a first look or something like that. And it's cleverly worded in that like there's some relationship between a potential distributor and the filmmaker, when really it doesn't mean much other than, hey, we'll take a look at the film. But it's being presented as if, or implied as if, there's a distribution scheme available and a revenue stream, when that's not necessarily the case. So those are sorts of just examples in the disclosure realm where, people can run into trouble. And of course, it's a natural tendency to want to put your best foot forward. But I think, as Bianca and Donovan are saying, that if you're not really showing the full picture, and it's okay to say, hey, we're putting together a film. We may not have done this before, but we have a reasonable budget. We have some talent, maybe or maybe not. And we're going to go to film festivals and just see if we can pick up a distributor. Or we're going to go find a producer rep. Or we may have some producer reps that might be interested. That is perfectly legitimate to say, hey, this is where we're at, and we're seeking investors for that.
Because that allows the investors to have an accurate risk calculus on whether or not to proceed.
So just to kind of summarize the overall investment area, there is a lot that goes on when you're trying to raise investment equity, where there is the due diligence that you need on your business plan, your budget, and then actually structuring as to who you're offering to, where are you going with your offering, and what you're able to do depending on the type of investor you're seeking. Bianca, the security laws recognize the difference between a sophisticated investor and a non-sophisticated investor. I don't know, Donovan and Bianca, if y'all want to talk briefly on the difference between those classifications and what that means for your filmmaker offerer.
Okay, so there is actually not really a codified definition of sophisticated versus non-sophisticated. Like I said, there is actually an accredited investor
Oh,
definition.
I'm sorry.
Yeah.
That's what I meant to say,
And-
accredited versus non-accredited. Thank you.
And so there's a three-part test. The last I checked, it was if you in total assets own in excess of $1 million, excluding your home, then you are qualified as an accredited investor. Or if your annual income, Donovan, remind me, is it over 150 a year, or as a couple? over
200
I think it was
for the past
200.
years. Mhm.
Yeah.
200.
And
And then there's
300
another, like
with
maybe
your
350 as
spouse.
a
Mhm.
couple. Yeah.
Yes.
And but you really, again, can you accept up to 35 non-accredited investors without losing your Reg D 504, 505, or 506 exemption? You can accept money from up to 35 non-accredited investors. Should you? No, you shouldn't, because non-accredited investors really have no place in alternative investment class assets that are at best 1 in 10 make money, right? And so we want to keep people in the right lanes, because individuals that get surprised by an outcome that they weren't expecting are those individuals that become litigious. And we want to keep things out of the courts. We want to make movies, not, work for litigators. I also wanted to take a minute and explain to why a PPM is so important, because it stipulates the waterfall. And what waterfalls typically sort of industry standard look like or should look like. And so it explains to an investor that you put in X amount of money, you're not going to be getting the first position recoupment, right? There's going to be a distribution fee. There's going to be a distribution expense. That's an off the top. Then a P&A allocation has to be recouped, prints and advertising, the cost of marketing the film. Then there's going to be a sales agent fee and a sales agent expense for doing international sales. Then there's going to be the cost of a CAM, a collection account manager, that collects the various receivables from the various distributors and broadcasters that have bought the rights to exhibit the film. Then there's likely, going to be, if it's a Writers Guild, SAG, Directors Guild, there's going to be guild payment obligations. Then there's the senior level of, if there's a bridge lender, there's their lenders. There could be a bridge. There could be a secured lender. There could be an unsecured senior lender. There could be a mezz lender. Then after that, you get into the recoupment of equity investors. And typically then all equity investors you'd like to see that they all get recouped on a prorated pari passu basis until they receive 100% of their investments back. And then there's typically a preferred return. The current market is somewhere between 15 to 20% of their investment as a preferred return. Then you may see a creative corridor whereby certain above the line talent participants, collaborators would get a little bit of a top up, because we wanted to keep the budget at a certain rate and not exceed that budget. So we were able to pay them X from the budget, and then Z in this corridor as a contingent deferred piece of compensation. And then do you come to net profit participation, which is typically allocated 50% to the producer's pool and 50% to the financiers pool. The producer's pool is sub-allocated to the director, the writer, the actors, the editor, the composer, etc. And the financiers share is, again, treated on a pari passu pro rata basis, such that if one person strokes a large check for the entire budget of the film, they should be entitled to 100% of that financier's share, which is actually 50% of 100%. And accordingly, if there are two investors, then they share that equally, and so forth and so forth. And so that's really, it's integral to have every investor that is reading the PPM understand that piece. If anything at all, that's the piece that you should be focusing them on.
Great. Jonathan, you want to jump in or anything? I want to try to move us beyond investment here just a few minutes to get on some of these other topics. What are the thoughts on investor funding?
So the water, just quick thing, Bianca is right about the waterfall, but just bear in mind that it's subject to negotiations. I've seen variations on that theme.
Absolutely.
For
but
example,
that's sort of like a
yes.
sweet, safe spot for industry
But
standards.
but producers should be prepared to get pushback from some investors who want 30/70 for the net profits, or who want the return of their principal and interest to occur further up the chain, or even first dollar out, right? So these things are negotiable. Just bear that in mind and remain flexible.
And so, just a couple quick points on that. So generally, if it's just investment only financing, I think to summarize what Bianca, correct me. Generally speaking, any expenses that are true third-party expenses will get paid, and then after those expenses, there's a priority to recoup your investors plus an interest payment of I usually think it's 20%. I've not seen 15, but 15 to 20% is what Bianca is saying. And then only after the investor has recouped, gotten an interest payment, then is there some sort of split of net profit. Now, I just had a film not too long ago where my client was putting in about $4 million investment money into the film. Donovan raises a great point. Part of the negotiation was producer credits, other things that were going on, and they also had some security in some foreign tax credits, which we'll talk about in just a bit. However, as the remaining portion of the film had to be debt financed, and they were shuffling around potential lenders. And so every so often we were getting shifted in the waterfall in order to satisfy the senior debt, which wasn't a lot of fun, but there wasn't a lot that we could do other than either put up more money to put us in a better position in the negotiation, or succumb to being subordinate to lenders who, when we talk about lending in just a moment or two, are not risk takers. They want to know, and they're calculating what they're doing and going from there. Let me just summarize the securities end by saying that there is a lot involved in this. You need to be very careful both in your planning as well as how you're going about this legally. There are ways to do this relatively inexpensively compared to other costly ways, such as what Donovan, I think generally $15,000. Sometimes I've seen it as high as $20,000 or more to do a full-blown offering with private placement manual and expense filings. It can run a lot of money depending on what your budget is. Any last comments, very briefly and quickly, on investment financing before we get into some of our other topics? Bianca or Donovan, any last words on this?
So
go ahead, Donovan.
Bianca, you go first, and I will jump in after.
Oh, I wanted to sort of segue onto equity is incredibly important. It is the cornerstone of every financing model that then leverages that equity through monetized tax credits, pre-sales, again, that are collateralized, and then unsecured debt, in-kind contributions, et cetera, which we'll get to. But typically, you need that private equity to be able to back talent offers, and only then does it become real, because you can't execute pre-sales without closing your talent deals, and you can't close your talent deals unless you put up some portion of the pair play, which requires that equity backing those offers.
Donovan?
I don't want to sound like I'm disagreeing with Bianca, but I usually advise my clients in structuring their financing, and their financing strategy is to try and get as much soft money as possible first in your budget, up to 80%, and then seek equity investors for the rest, because it's less complicated and it's much better for you, and as a filmmaker you get a greater upside. So I usually advise the other way around.
Define soft money for our audience, Donovan.
Yes. So like Tennessee tax credits, if you're filming in Tennessee, or cash rebates. So soft money is money that you get in terms of tax credits, rebates, tax deductions, and so on. These can be used to cash flow your production, and if you can get most of your budget that way and then get the rest of it in private equity, you're much better off logistically from accounting standpoint, and also in terms of the upside if the film does really well. Another thing that I don't think we mentioned in the waterfall are profit participants and deferrals.
I think Bianca did mention that. Didn't you at
Okay.
the end there, Bianca?
Yes.
Yeah.
Mhm. Yeah.
Okay, perfect.
All right, I'm gonna move us along because I just want to keep us on time in terms of covering different topics. Again, I know we'll have other perhaps questions of things. Yes, soft money. There are grants, brand integrations, crowdfunding, music investments can also be soft money if you have the ability to attract those things. That's a comment from Brooke in our chat.
But
Just
you can't get that until you spend it to qualify.
correct.
I mean, grant aside.
Usually on tax credits, you have to spend within the jurisdiction and then apply to get that money. Some states will allow you to sell those at a discount in advance. I think Louisiana had a big system for a while, but we'll get into that in just a moment. I do want to just cover
Just quickly, Kirk, but some states give you a pre-certification for the tax credits, which you can then take to a lender and borrow against.
I tell you what,
Talk
why
about
don't
that.
we get into tax credits right now since we're already here? We're flexible. We can jump around here in our discussion.
No.
Let's
Keep
talk
going.
about tax credits. Who wants to go first and explain the concept of the tax credit system? Donovan, do you want to talk first about domestic tax credits, and then Bianca get into international ones and things to know? Why don't we start that way?
Sure. So state tax credits, and some states do offer cash rebates as well, which they provide upfront, and you have to pay that back if you don't produce the movie. But how a tax credit works, you have different types. You have those that are transferable, meaning you can sell them, like in Georgia, and you have those that are non-transferable, which means only the production company can utilize the tax credits. So you get a percentage of your eligible expenses for production above and below the line, and various states have different rules regarding which above the line line items are eligible and which are not. So we have to carefully review that on a state-by-state basis. But let's say in Tennessee, I believe the tax credit is 25%. Forgive me if I missed that part of the video. So it's 20. You get a certificate for 25% of the eligible expenses for those expenses that are made within the state, and you can take that to the bank or to a lender, and you can borrow against it. Of course, it comes with a premium, or you can finish the film, and then I think you get a tax refund, which you can hold on to it as a production company, depending on the arrangement you have with your investors, or you can pass that through to your investors, whether it be an equity investor or a debt investor.
And it's really critical. Remember, these are economic development programs for a particular state. So they want to make sure that you are spending and complying with each step. One of the key things is to make sure you are in compliance with whatever those state requirements are in order to get the type of benefit that Donovan described. Bianca, I'm going to turn to you. I know you do a lot of international financing with tax credits. You want to just talk about the international market, how it may be different or the similar to states?
Okay, so I have advised on Connecticut, South Carolina, Georgia, California, Florida, New Jersey. I feel like I'm missing a couple, which none of them are remotely similar to the others because some qualify flights going in and some qualify flights only going out, and some put a cap on the above the line spend and others. So again, you have to look very deeply at the devil being in the details. International tax credits are not dissimilar. Sweetheart, I'm just doing something right now. Can you just give me a second? Thanks, my kid. So currently I'm working with the Dubai Sovereign Wealth Fund. They're putting together a very robust tax credit program. Ireland had one. Actually, the UK was just overhauled. The most progressive, aggressive change since, I think, 1997. And that's being implemented this month. Out of all of those internationally, I think the most lucrative, I just did a couple in Hungary, but I think Vienna, Austria has the richest available tax credit deal. And again, it's intended to repatriate runaway production to then be, a boost for the tourism and trickle-down economy. So we could talk about, maybe this is a good segue to say, when you qualify for the tax credit, you can treat it two different ways. You can get it monetized through a loan and apply it towards your budget, or you can wait to get it directly from the government entity once you've been audited and certified. And then you can treat it as a part of the gross proceeds and just put those proceeds through that waterfall. Typically, people want to cash flow it in advance. So what does that look like? When you go to an institutional or a private lender, you'll get your tax credit certification. You'll run your sort of expense statement and the anticipated spend that qualifies. And then the lender is going to take out commonly a 10% interest reserve. So whatever the total qualifying amount is, minus 10% that they hold back. There's also going to be an allocation for legal fees because the filmmaker has to pay the legal fees for the lender. And there's also going to be a closing fee that is typically 2.5% of the total principal loan amount. So, you kind of you start cannibalizing down the available sums that will be forthcoming from the government authority. And also there's a timing issue. You really don't want to go exceed a 9-month term. If possible, it's best to avoid that so your interest doesn't run. The lender wants it to be out as long as possible. The filmmaker and investors want it to be out as short as possible. And that's another consideration for where you want to place your production, because sometimes there's a lag time. There's the first part of a tax credit or rebate will vest at a certain window, calendar window, and then there is a lag. And so that creates a stretch to the loan, and then that increases the amount of the interest that you have to pay. So just, again, things to look at closely. We can get into what the debt mechanics.
Well, we'll get into that in just a moment. I just want to talk generally about tax credits. I'll just add, and I think this is a hybrid between both what you're all saying. If you have tax credits, they're good tools in how you negotiate the waterfall. For example, and this is an unfortunate story I have right now. I was not involved in the original deal, but I'm involved in the cleanup. UK film that that was shooting in Latvia, hired a company to do production services work in Latvia. The production services company in Latvia essentially contracted to make sure that they complied with Latvian laws to get the Latvian tax credit. The UK company, in negotiating the waterfall between the debtors and the investors, this and that, made a deal with a key investor to allow the investor to get part of their money back when the Latvian film tax credits came in, or that dollar value, I'm sorry, whatever the economic currency is in Latvia, when that monetary value came back in Latvia. Turns out the production services company in Latvia messed up. The production did not qualify. And so they have an investor now that's rather upset that what they thought they had partly securing their money in return is not there, and you get these sort of messes. But that's an example one of how you can negotiate a waterfall if you have some of this soft money, and two, you better darn make sure it's there when the time comes. Don't want to get too much into tax credits. There are people making comments about the various different components. They're out there. They are government legislated. I thought I saw where Georgia was at one point going to limit their the amount of money they were going to provide. There are some states now that are expanding it into video games and other components. I know New York at one point for a good while was allowing tax credits for post-production, so that even if you didn't shoot in the state of New York
Yes,
and
we
you're
do.
just going to do post in New York, then you could get tax credit. So there are all sorts of different formulas, and just want our audience to know that that is an important component in the film financing.
It's
state.
important. However, I also talk filmmakers out of unnecessarily chasing tax credits by having to have a company move, because the cost of shuttling everyone over there to chase that credit and qualify for it exceeds the expense in having to do so. So, or alternatively, you can get a fortune out of, let's say, Saskatchewan, but try to get your lead talent to go shoot there in January. It's not as
Yeah.
easy. to do, right?
These are
So
all very
theoretically,
important
works.
practical points.
Yeah.
When I started off my film finance career, Isle of Man was the big place to go. I don't know if there's still,
Yes.
I've done an Isle of Man deal in a while, but always a lot of fun. All right, let's just talk briefly about Section 181 tax. Everyone, I guess it's been extended now by Congress. A lot of people always ask questions about, hey, is there a benefit in Section 181 for potential investors? I don't know who wants to start off first talking about 181 as a tax credit under federal, under the IRS laws, and if you see it much in your practice.
So it started out originally in 2004 as part of the U.S. Jobs Creation Act, and it was kind of predicated on what Germany was doing under this defeasance model. And so the thinking was, if you have qualified, it was to repatriate runaway production again from Canada primarily. And so if I think it was up to 15 million originally in its original form, and you had X amount of spend, and there was a slight qualifier, like you couldn't, commercials didn't qualify for it, and other, content was excluded. And then over the years, it has been abused and over leveraged. And so they have refined it. And I haven't done a 181 in some years, because to me, it's a tax deferral, but it's not, in my experience, it hasn't been the thing that knocks an investor off the fence on proceeding with an investment. It's sort of, kind of feathering a nest, but not the decisive factor.
Do you want to explain, or Donovan, what exactly does the investor get if they talk to their CPA and get a Section 181 deferral?
I'm excited because I totally agree with Bianca. It is a tax deferral, and also if you're not a high net worth individual with major tax liability, you really don't benefit because it's you never it's a tax deduction, not a tax credit, right? So it lowers your taxable income, but you will never get a refund. So if you don't owe taxes, you can't really use Section 181, but it does help.
Kinds of taxes that it applies to. So active, like salaried taxes.
Right. So that's getting into what type of income is taxable income is covered. So it covers ordinary income as well as capital gains. If you are making money from real estate,
Passive.
there are other laws, tax laws that regulate that. So you wouldn't necessarily get a tax deduction on the Section 181 if it's for a film and television project. But if you have income that's taxable and it covers a wide range of taxable income, you can deduct up to 100% of that income, the amount that you will owe in taxes. That is for up to the amount of money you spend within that tax year. One thing to understand about Section 181 is that it covers the expenses once the investor puts the money into the account, whether it be in escrow or some other type of account, and it's not contingent on commencement of principal photography within that year, as long as there's a reasonable expectation that principal photography would begin before that period runs out. And in right now, that period is December 31, 2025. So if an investor invests in 2024, even if the production doesn't start in 2024, in 2025, the investor can make that section 181 tax election on their tax return and get that deduction.
My understanding was also that you can't actually deduct it against your ordinary income unless you're deriving your ordinary income from film-related activities. So you can't be sort of like a doctor and put it in and then offset your salary from being a doctor based upon that investment, unless you qualify for actually being, and there's like a test of how many hours you allocate towards that during the fiscal tax year. But you can offset it against passive income, which is rental property and like royalty stream. But there is a whole bunch of footfalls that you could trip up on. So it's, again, look at the details in this. And you can't take 100%, that you can't allocate 100% of the loss that the company is qualifying for under 181 and give it to one investor. It's prorated based upon the degree of investment among all qualifying investors by a qualifying feature or television content.
And there are operators out there that structure films on 181 tax credits. I had a project actually, someone from Tennessee that actually had this whole funding scheme based on 181, and I think the packet was yay thick about explaining everything. We're just touching on it right now to make sure our audience understands it. It's just something that you have to look very closely at, and it's not what everyone thinks it is. And that's the key thing. And you have to be very careful, especially if you're going to investors in your private placement manual and you're selling 181 and representing it as something that it's not, then you're going to run into some trouble there. All right, we still have good time now to talk about debt financing. And this is where we want to utilize the knowledge and experience of our panel. Hopefully a number of y'all here or aspiring will get to a point where you will have things going for your project that would qualify it for debt financing. You might have key talent involved. You might have a pre-distribution interest because a distributor is willing to put money up what used to be called a negative pickup deal. I don't know if they're still called that these days. You may have some sort of advanced pre-sale that you could then find some financing or other sorts of things. So we want to talk about what does that look like when you're dealing with debt financing. In your materials, there's a general diagram, and it is just a general diagram of all the different parties involved in or types of issues involved in debt financing. you have an overload of redacted debt financing related documents. We're not going to get into all that, but that's for your reading pleasure, especially if you can't go to bed at night. And what we're going to do is give an overview of how debt financing works. What are the key considerations you need to be aware of? And then what are some of the pitfalls? And then assuming if we have some time, we're going to get into just a few other closing topics before we close out. I told everyone to hang on your seats, so hopefully you're still hanging on. Bianca, do you want to start generally in the overall picture of how debt financing works and what's kind of the bigger picture, and then we'll just start going down from there?
So let's assume that you have a budget of $10 million, right? Or $10. It doesn't matter. Just let's, for purposes of easy numbers, let's say it's 10. So if you can qualify for, let's say, if you qualify for 2.5% or $2.50 of your budget from tax credits, then let's look to pre-sales. Why do you want to enter into pre-sales? You can't get to debt until you enter into some pre-sales, because that is the way that a lender can understand whether or not there's an appetite in the marketplace and how risky ultimately their loan to you is going to be and how they should price it. So you should contact a sales agent. The sales agent will give you estimates. There's an ask. You're asking for pie in the sky. You throw that number out, and then there's a take. And so they can't sell beneath the take without the filmmaker's approval. And so you really focus on those take numbers. Let's say that lenders also want to sell different areas to make sure that, you know, the same appetite is happening in Asia as it is in Latin America, as it is in Europe. You want to try to hold back your North American sale because that's really kind of the profit center.
I was just about to make that point. You're ahead of me. Go ahead.
Yeah. So let's say that we do enter into these minimum pre-sales, and let's say that we sell 20% of your budget through pre-sales. So now we've got $2.50 in tax credits. We've got $2 in pre-sales. Let's say that the overall estimated value, the take, is $14 on a $10 budget, conservative. So taking $2 in pre-sales from the overall 14 leaves us with an international sales value of $12. A lender is willing to lend up to, and no more than, half of the open and unsold territory. So in this case, that's $6. So $6 in prospective debt. There are more conservative lenders that will bring that number down, but there are lenders out there that are, you know, willing, and I can tell you who they are if anyone's interested in emailing me later. So of that available $6, 20% of the budget will be priced at a senior rate. So that's $2. And then you're prospectively available to get another $4 in a more expensive rate, or a bridge rate.
A mezzanine loan.
A mezzanine loan, yeah. So let's say that you can get $2 in pre-sales, $2 in senior, and let's not stress that like utilizing all the available $6 in debt. Let's just say that we get $2 in mezz. 2, 4, 6, 8, 8.5. All right, so that leaves us with a shortfall of $1.50, and that's your equity. Or your post deal, or you sell VR rights, or you make a deal with your composer, or you put a product placement play in, or I mean, there are many different other avenues other than equity. But so the higher the debt, that's kind of how you bring down your equity amount. So when we talk about that debt piece, I was looking at, I had just closed, I did this crazy Johnny Depp movie, and we had for that 37 different documents for the loan closing, right? So there's the traditional loan agreement. There's the pledge agreement that is essentially a mortgage in favor of the lender by the local production services company.
And that's a mortgage on the asset and the copyright.
The collateral, even if you are entering into a tax credit loan, to avoid what happened to you in Latvia, the lender is going to want more collateral than just the tax credit. They're going to want the pre-sales. They're going to want the unsolds. They're going to want if they have to sell it off for scrap value, they're going to want all future receivables. They're going to want the production office furniture. They're going to want the costumes. And it's your job to push back on that, but that's what they're going to be asking for. So depending on what side I'm representing at the time, that's the dance. A part of this was in the UK, so we call that a notice of charge, which is just another security assignment. There's the notice of delivery that the sales agent will sign. There's various notices of assignment. This one didn't happen to have a completion guarantor, but typically there's going to be a completion guarantee.
So, can you identify what a completion guarantor is for our audience? A
Yeah.
bond company?
Yeah, it's a bond company that comes in, and there's really only like 2 left in the business. So it's a company that comes in and for a percentage of the budget, typically 3 to 6%, they're going to guarantee delivery. So if the director starts going over time and over budget by X amount, and that's negotiated, they come in, they step in, they take over production. They do not create high art. They just do the bare minimum to be able to hit the delivery as quickly and as cost efficiently as possible. And then if they're not used, then they'll charge you like a 6% of the budget and they'll refund 3%. And if they are used, then they become a creditor in a position that's subordinated to the rest of the lenders and recoup in the waterfall with interest based on how much they've had to out of pocket to be able to deliver a completed film.
And I'll just jump in real quick and say not every producer or filmmaker will qualify to be bonded with a bond company. They're not going to just take anybody to cover. Go ahead, Bianca, and then we're going to let Jonathan jump in here.
So I'm just looking through the other documents. There are like lien searches you have to go through. There are lien subordinations you have to go through. There are UCC filings that you have to make. You have to have the insurance company have the lender become a beneficiary under the various policies, not least of which is E&O, errors and omissions. Then you've got a CAMA as part of the closing documents. You've got a blocked account control agreement. For the collections account, you've got a security agreement between the CAM, the borrower, and the lender. You've got deposit account control agreements for both the tax credit account as well, if this is a tax credit loan, or just the production account. Then you've got a copyright mortgage that is signed by the borrower, the production services company, and typically there's a sub-production services company. You're going to have to verify your chain of title. The lender's going to have to verify sales agency agreement. There might be a sales agency inter-party agreement, which is different than the inter-creditor agreement. If there are other lenders, it kind of stipulates the order of who is more senior and who is more.
The pecking order between the parties.
A packing order that will have delivery schedules and notices of assignment. Then there's going to be the distribution agreements if any pre-sales have been entered into, because chances are there will be, with notices of assignment in favor of the senior lender. The production services agreement will be part of the closing documents, sub-PSA, various delivery schedules, post schedules, cash flow schedules, guild agreements, key cast and crew list, corporate documents, certificates of officers on behalf of the borrower, showing that, someone is authorized to sign on behalf of the borrower, certificates of good standing on behalf of the company itself as borrower, certificates of status by the production services company and sub-production services company. If there is a tax credit component to the loan, tax credit engagement letter, opinion letter by a consultant verifying a reasonable expectation of how much the tax credit will be, a security deposit agreement between the production services company, the tax credit bank and the lender, the repayment request, under lending letter, quota pledge agreement, tax credit application certificate, and know your client or know your customer docs. So it can be a very involved process. Typically, if you're dealing with an institutional lender, it takes about 60 days. If you're dealing with a private lender, it's between 20 and 40 days. But you should, give yourself enough lead time to hit the necessary pre-sales between markets. So look at the calendar year, make sure your sales agent will be able to optimize, time in Toronto and time in Cannes and time at AFM and time in Berlin to hit the necessary minimum pre-sales requirements to be able to then close in time to start cash flowing when you need pre-production to start, and make sure that you're not postponing your green lighting.
Great. Donovan, you want to jump in on any thoughts on what Bianca has talked about, or anything to add on debt financing? And we still have time on this topic, so we can dive in it anyway. It's a lot there.
Yeah.
Absolutely. Uh, Having errors and omissions insurance may also be a requirement. I think Bianca mentioned that. Also, how does one get pre-sale or minimum guarantee, right? Not every project is going to be eligible for an MG. So speak with your sales company or sales rep, and they will guide you with regard to that. And having sales estimates
Selling
alone.
unnecessarily, because again, you're pre-selling at a discount because the buyers are taking a risk on whether you deliver, whether it's a quality product. So you really only want to pre-sale the minimum amount to be able to qualify for the loan that you're asking. Sorry to interrupt.
That's okay. That's all right. Uh, I don't remember. Yes, having a completion bond may also be required, especially if you're getting into debt financing, because the lender wants all kinds of sureties, and that the film will get made one way or the other. One thing that Bianca didn't mention is the contracts. So how do you prove chain of title? I've seen pretty sized budget films where the producer acquires underlying rights, it gets their screenwriter friend, and they write a wonderful script, and they raise the money and start filming, and now it's post-production time, and they're trying to figure out chain of title, and they have no agreements in writing. And the producer claims that she owns the project, and the director claims that he owns the project, and it's chaos. So have everything in writing when it comes to US copyright law. Whoever contributes makes a creative contribution to a project is a copyright owner, unless it's in writing and says otherwise. So always get it in writing, and be prepared to prove or to show that there are no gaps in the ownership of the project from its inception all the way to the finished film.
Great. So just very quickly, Bianca, I know you and I talked about this as we were prepping for this. Important point, if you are getting a lien on a foreign copyright, how do you perfect that lien in the United States?
UCC filings.
And where do you file that?
Online. It's not a very complicated process, but it's a necessary process.
Yes.
You would be astonished by how few people actually complete that step.
That's why I'm telling everybody. And filing in DC for a foreign asset?
So, I mean, I take a belt and suspenders approach. I file UCC, as well as if it's posting in one country, as often a film will, and it's shooting in another, I file in the UCC equivalent in every single jurisdiction where any component of the process or anyone is.
In order to protect your interests.
Yeah.
All right. In just the few minutes we have, we've gone a quick view over debt financing, nonprofit films. I think the key, if you're setting a nonprofit, is the nonprofit is the entity that owns the project, and it is nonprofit. So if there's some filmmakers that I've dealt with that will create a nonprofit and sort of feel like the nonprofit is their personal vehicle, but there are IRS litmus tests with respect to the number of board members you can have, and likewise, if you ever dissolve the nonprofit, then that asset must go to another 501c3 or nonprofit according to the IRS rules. And if you're going to buy your that film out, then you're going to need a fair market value. nonprofit crowdfunding. This is just kind of any quick little thoughts from our audience about those methods, just in the minute or two that we have before we try to see if we can throw a question in here.
Well, if you're using a nonprofit to make your film, one, you have to consider state law governing that nonprofit, and you will have to ensure that you're in compliance. For example, is this film part of the charitable purpose of this nonprofit?
Which is typically educational.
Well, not if it's, sci-fi horror. It might not be that educational. So,
Yeah, to comply. I
so
don't know if I've seen a
if you're
sci-fi
making,
comply with the
right,
501c3.
I've
but
seen
yeah.
that. I've seen, yes,
So
I've
for
seen that.
scientific, I guess, maybe, I don't know. Anyway.
It's fiction. So that's important to ensure
point.
that the project fits within the charitable purpose of your organization. So check with the organization's bylaws and 501c3 status.
All right, we've got like just maybe 5 minutes. Are there any quick questions in the chat that anyone wants to throw in that we can add? Otherwise, I'm just going to ask, give Donovan and Bianca a moment or two just to any closing thoughts before I go to them. Any last questions? I think all the codes have been sent out here. If you have a question, throw it in the chat because I don't think we can get you on live given our time crate. All right. So closing, we just got maybe 3 or 4 minutes to close. Donovan, what is your any last thoughts, advice for our audience on anything that we've talked about?
So consider equity crowdfunding as an option, and also donations-based crowdfunding as an option, and consider family and friends. Put some skin in the game. If you have a project that is about a topic that has meaning and value for people, they will support you one way or the other. And so try to position your project to appeal to these sensibilities and interests of your audience, and try to get it funded that way, in addition to all the other avenues we've discussed earlier.
Bianca, any closing thoughts on anything?
Sure. I've seen some sort of the crowdfunding 2.0 that seems to be a buzz within the industry is the sale of NFTs to be able to raise financing for various projects. And that in itself is a contravention of federal and state securities laws. So be very, very careful when making representations and using that as a means of currency to fundraise, because you could very quickly find yourself on the wrong side of the law.
Great. All right, and I'm gonna just close by just saying, especially with investment disclosure, transparency. So Donovan and Bianca, thank you for joining us today. Thank you to our audience. You can tell we could just take any of these topics and spend on each of these topics 2 or 3 hours. So this has been a quick 90-minute plane ride through the world of film financing. I think all of us are available for any emails that you may have, follow-up questions or anything like that. Happy to answer them as best we can.